You're
Prepare
watching
to be stunned.
Silver News
China
Daily.
is secretly
Subscribe
plotting
for
to
more.
dominate the silver market, and this could send prices skyrocketing to $2,000 in the coming weeks. How is this possible, and what does it mean for investors? Keep watching to uncover the hidden details behind China's bold strategy and its potential impact on the global economy. Don't forget to subscribe to our channel for more breaking news and insights.
But I think the main driver for gold in the short term, though, again, we're not thinking, again, until the Fed starts cutting interest rates, I don't think, gold is going anywhere as far as U.S. investors concerned. In fact, if you see like GLD, for example, we've seen actually outflows from GLD, to the extent that I can imagine, U.S., if you're a retail investor in the U.S., you're getting 5.5% by parking your money in 3-month treasury bills. Like, why would you basically want to buy gold? Especially you think, you can pocket 5.5%. But I do think that the driver of gold, this is why China as a driver of gold is interesting. The demand for gold is coming from China. It's not coming from the US, okay? It's coming very, very clearly from China. It's not just coming from the Chinese central bank reserve accumulation, but also coming from Chinese retail sector. Because right now the Chinese economy is struggling. Interest rates are very low. Bond yields are very low. The stock market has been very volatile. The property market has been going down. And then Chinese retail investors don't have the ability to invest abroad. So as a result, there has been a bit of a craze, okay, when it comes to gold. There's been a lot of reports about like retail savers walking to jewelry stores and stocking up on gold bars. So you have 1.4 people doing that, even a little bit of gold bar for each person, that could definitely prop up demand for gold. And I think, as I said before, for the Chinese central bank, the rising, I think the relationship between US and China has never been worse, and is set to get probably much worse. So I think I'm going to assume that rising tension between US and China will also basically almost guarantee that the Chinese will keep diversifying away from the US dollar. And I think, into gold. Okay, so I think, from that point of view, if you want to basically buy gold right now, like your argument has to rest on what China is going to do, rather than what the US is going to do, what anybody else is going to do for that matter. And China is therefore, no question, I think every gold investor should really acquaint themselves with actually what's happening in gold, because that is the biggest driver of gold price lately, and likely to remain so at least in the foreseeable future.
In recent months, the silver market has shown significant volatility. Prices have fluctuated due to a variety of factors, including economic uncertainty, fluctuating demand from industrial sectors, and changing investor sentiments. Silver, often considered both an industrial metal and a precious metal, has unique properties that make it a valuable commodity. It's used in electronics, solar panels, and medical equipment, which keeps demand high even when market conditions shift. Historically, silver has been a reliable store of value similar to gold. During times of economic instability, investors flock to silver as a safe haven asset. This duality, its industrial use, and its role as a hedge against economic downturns, makes silver unique. Over the past decade, the silver market has experienced several peaks and troughs. For instance, the price surged in 2011 due to economic fears, and again in 2020 amidst the global pandemic. Each spike was driven by different factors, but the underlying theme remains the same. Silver's value is closely tied to global economic health. Recently, the demand for silver has been bolstered by the growing emphasis on green technologies. Silver is a critical component in photovoltaic cells used in solar panels, which are essential for renewable energy projects worldwide. As countries strive to meet their green energy goals, the demand for silver is expected to increase significantly. Additionally, silver's use in electronic devices and medical applications has kept industrial demand robust. On the supply side, silver production is concentrated in a few key regions. Countries like Mexico, Peru, and China are among the largest producers. Any disruptions in these regions can have a significant impact on global supply. For example, labor strikes, environmental regulations, and political instability can all affect silver mining operations, leading to supply constraints and price increases. Investor sentiment towards silver has also been influenced by macroeconomic trends. With inflation concerns rising, many investors are turning to tangible assets like silver to preserve their wealth. Central banks' monetary policies, especially in response to economic crises, play a crucial role in shaping these sentiments. Lower interest rates and quantitative easing measures often drive investors towards precious metals, including silver. Another factor contributing to silver's volatility is market speculation. The advent of social media and online trading platforms has made it easier for retail investors to influence market prices. The silver squeeze movement earlier this year, driven by retail investors on forums like Reddit, demonstrated how coordinated buying efforts can temporarily drive up silver prices. Against this backdrop, China's strategic maneuvers in the silver market become even more intriguing. As one of the largest consumers of silver, China's actions can significantly sway global supply and demand dynamics. The country has been increasing its silver reserves, a move that many analysts interpret as part of a broader strategy to gain more control over the global market. This is particularly relevant as China seeks to strengthen its position in green technologies and reduce its reliance on foreign suppliers. China's increasing presence in the silver market is not just about meeting industrial demand. It is also about positioning itself as a dominant player in the global commodities market. By controlling a substantial portion of the silver supply, China can influence prices and availability, giving it a strategic advantage in international trade and economic negotiations. The recent reports indicating China's aggressive accumulation of silver have raised eyebrows among market watchers. This trend suggests that China might be anticipating a significant price increase, possibly driven by a combination of increased industrial demand and geopolitical tensions. If China continues to buy silver at this pace, it could lead to supply shortages and drive prices even higher. In conclusion, the silver market is at a critical juncture. With its unique role as both an industrial and precious metal, silver is influenced by a myriad of factors, from technological advancements to geopolitical strategies. China's increasing control over the silver market adds another layer of complexity, potentially setting the stage for unprecedented price movements in the near future. As we delve deeper into China's economic maneuvers, it becomes clear that the silver market could be on the brink of significant changes.
I'm general short consumer discretionary because I think that high energy price and high mortgage rates are a terrible combination for U.S. consumers, and so I'm short consumer discretionary against staples, as a sort of a sector relative value trade, which I think is actually a very attractive way to express a negative view on the U.S. consumers. Especially given the fact that I think I'm very bearish on Tesla in general. I think, Tesla had a, big run up in the last 2 weeks because of, the story about China doing this deal in China, which I think is all bullshit. But be that as it may, I think the whole Tesla story, which has actually, I think Tesla is about to basically to have another leg down. And I think that will, because Tesla is the biggest component of U.S. consumer discretionary index, S&P, right? So if I'm right about that, that will only reinforce this trade. So I'm definitely thinking that the U.S. consumers are struggling right now, and especially the labor market showing some signs of softening, and the Fed not being in a position to actually come to the market's rescue because of still elevated core inflation. As a result, this is actually not a happy environment for financial markets, especially we're not officially in May. The whole sell in May and go away. I think psychology is going to start to gain traction in the coming weeks. So we'll see how it goes. But I think, in general, I'm thinking that over the next few weeks, okay, I think, we're going to see oil price heading higher because of rising geopolitical risk. I think Russia is going to launch a major offensive as we head into the second half of May, which has been my prediction for a while. The second half of May, after the Russian Victory Day, I think the U.S. election risk is going to be going up at the same time, just when the economy starts to roll over a bit. So I'm thinking May and June will probably not be very pleasant, I think, for most risky assets.
China's economic strategic positioning in global markets have always been a subject of intense scrutiny. As the world's second-largest economy, China has been making calculated moves to strengthen its influence across various sectors, and the silver market is no exception. Let's explore how China's broader economic strategies are setting the stage for its dominance in the silver market. Over the past few decades, China has transitioned from a primarily agrarian society to a global industrial powerhouse. This transformation has been driven by a mix of state-led initiatives, significant foreign investment, and an insatiable demand for resources. China's rapid industrialization has created a substantial need for commodities, including metals like silver. This demand is fueled by various sectors, particularly technology, manufacturing, and green energy. The Chinese government has long recognized the importance of securing staple supplies of critical resources. China has invested heavily in mining operations both domestically and internationally. By controlling substantial mining assets, China aims to ensure a steady supply of essential raw materials. This approach is evident in its activities in Africa and South America, where Chinese companies have invested in mining infrastructure and secured long-term supply contracts. In the context of silver, China's strategy involves both increasing domestic production and securing international supplies. Domestically, China is among the top producers of silver, thanks to its vast mining operations. However, domestic production alone is not sufficient to meet its growing demand. Therefore, China has been actively seeking to acquire silver from international markets. This approach of bolstering domestic production while aggressively acquiring international reserves underscores China's intent to dominate the silver market. China's Belt and Road Initiative, BRI, further highlights its ambitions. The BRI aims to enhance global trade routes and infrastructure, connecting Asia with Africa, Europe, and beyond. This initiative not only facilitates smoother trade flows but also helps China secure critical resources along these routes. Many countries involved in the BRI are rich in minerals and metals, providing China with strategic access to these resources, including silver. Moreover, China's economic policies have been geared towards fostering innovation and technological advancement. The Made in China 2025 plan aims to upgrade Chinese manufacturing and reduce dependence on foreign technology. Central to this plan is the development of green technologies, where silver plays a crucial role. For instance, the photovoltaic cells used in solar panels require significant amounts of silver. China can advance its green energy goals and strengthen its position as a leader in renewable energy technologies. China's financial strategies are also pivotal in its quest to control the silver market. The country has been increasing its gold and silver reserves as a hedge against global economic uncertainties and to reduce reliance on the US dollar. This move is part of a broader effort to internationalize the renminbi, RMB, and establish it as a global currency. By holding significant reserves of precious metals, China aims to enhance the credibility and stability of the RMB in international markets. Additionally, China's approach to international trade and finance has been shifting towards de-dollarization. Amidst growing geopolitical tensions, particularly with the United States, China has been advocating for greater use of the RMB in global transactions. This shift is evident in the increasing number of trade agreements China has signed with other countries that allow for transactions in local currencies. Controlling the silver market fits into this broader strategy by providing China with a valuable asset that can support its financial system and trade initiatives. China's maneuvers in the silver market are not without challenges. The country faces competition from other major economies and must navigate complex geopolitical landscapes. However, China's centralized decision-making structure allows it to implement strategic plans more swiftly than many Western democracies. This agility gives China a competitive edge in securing resources and influencing global markets. In summary, China's economic maneuvers to dominate the silver market are part of a well-orchestrated strategy to bolster its industrial capabilities, support its green energy ambitions, and enhance its global financial influence. By increasing domestic production, securing international supplies, and strategically managing its reserves, China is positioning itself to exert significant control over the silver market. This move not only meets its immediate industrial needs, but also aligns with its long-term economic goals of reducing dependency on foreign currencies and asserting its influence in global trade.
And also, the only reason why the RMB is not even much weaker is because you've got capital controls in China. Right now, most Chinese, basically, retail investors don't have the possibility to actually get their money out of China. Let's just say they decide they don't want to basically buy Alibaba, they want to buy Google instead, or Facebook. That is not basically a choice that they have, okay? Because capital controls. So you could bet your bottom dollar if China were to suddenly remove these capital controls, like the RMB will collapse. So I think from that point of view, there's no way anybody can basically convince me that somehow the RMB is going to strengthen. Okay, at least not, I cannot see a way you could actually see a significant strengthening of the RMB. In fact, if anything, I would argue right now, the RMB needs to go down. Okay, in fact, I think, there's a problem in China. They need to lower interest rates. Interest rates are too high. There's no inflation, so lowering interest rates should not be a problem. The only reason why they haven't lowered interest rates already is because they are wary of further RMB weakness against the US dollar, which doesn't look good, okay, for the Chinese. So I think from that point of view, they are actually being held hostage by their aversion to a weaker RMB, but I think that shall pass, hopefully. But the bottom line here is that I don't quite see any currency to replace the US dollar right now. I do see over time, maybe on a 10-year horizon, I think, in general, I think we're in general moving from a unipolar to a multipolar world. It's just going to take much longer than people think it will. And then at the end of this new transition, and maybe we'll get there in 10 years, okay, there will be many currencies that will be, essentially that will be important. And maybe the dollar won't be the only one anymore. But the point here is that, as John Maynard Keynes said, in the long term, we're all dead, right? Right now, like if you want to make money, I wouldn't basically think too far ahead, okay? That's not to say the dollar is going to strengthen further from here. I actually think the dollar's probably peaked, actually, after last week. I'm very much of the view the U.S. growth is finally slowing. And as a result, I think, I've been very bullish the dollar through most of this year, but I think now I kind of feel like the dollar's peaked because I think U.S. growth has probably peaked. And then, and so the interest rate differential argument in favor of the dollar, I think is starting to, I'm not saying it's going to go the other way, but I think the upside for the dollar at this point is probably fairly limited. Whereas gold is actually still, to me, the most interesting alternative to the US dollar, if you like.
History provides several examples of how strategic resource control has led to significant economic and geopolitical shifts. By examining these cases, we can gain insights into China's possible motivations and the potential implications for the silver market. One of the most notable historical examples is the United States' control over oil in the 20th century. After World War II, the U.S. emerged as a global superpower, in part due to its vast oil reserves. The control over oil resources allowed the U.S. to influence global energy prices and exert considerable political leverage over oil-dependent countries. This control was further solidified with the establishment of the petrodollar system, where oil prices were denominated in U.S. dollars, enhancing the dollar's status as the world's primary reserve currency. Similarly, during the 1970s, the Organization of the Petroleum Exporting Countries, OPEC, demonstrated the power of strategic commodity control. By coordinating oil production and prices, OPEC nations were able to assert their economic influence globally. The oil embargo of 1973, led by OPEC, caused a significant energy crisis in the West, leading to soaring oil prices and economic turmoil. This event underscored how controlling a vital resource could have far-reaching economic and political consequences. In the realm of precious metals, the Hunt brothers' attempt to corner the silver market in the late 1970s and early 1980s is another significant example. Nelson Bunker Hunt and William Herbert Hunt accumulated large quantities of silver, driving up prices from around $6 per ounce in early 1979 to a record high of $49.45 per ounce in January 1980. Their strategy was to create a supply squeeze, making it difficult for other market participants to obtain silver. While their attempt ultimately failed due to regulatory changes and market interventions, it demonstrated the potential impact of concentrated market control on prices. China's current strategy seems to draw lessons from these historical examples. By increasing its silver reserves and securing supply chains, China aims to position itself as a dominant player in the silver market. This move can be seen as part of a broader strategy to gain leverage over a critical resource, similar to the U.S. with oil or OPEC with coordinated oil production. China's efforts to dominate the silver market also align with its historical approach to resource security. During the Ming Dynasty, 1368 to 1644, China was one of the largest producers and consumers of silver. The demand for silver was driven by the need for currency and trade, as silver was used to facilitate transactions both domestically and internationally. The influx of silver from the Spanish colonies in the Americas into China through trade significantly impacted the global economy, highlighting China's historical role in the silver market. In more recent history, China's control over rare earth elements, REEs, provides another parallel. China produces over 80% of the world's rare earth elements, which are crucial for manufacturing electronics, renewable energy technologies, and defense systems. By controlling the supply of these critical materials, China has been able to influence global markets and assert its economic power. The RE strategy has also given China significant leverage in trade negotiations, particularly with the United States and other Western countries. China's current focus on the silver market can be viewed through this historical lens. By controlling a significant portion of the global silver supply, China can influence market prices, secure its industrial needs, and strengthen its strategic position in the global economy. This approach not only ensures a stable supply of silver for domestic use, but also provides China with a valuable asset that can be used in international trade and finance. Furthermore, China's strategy to dominate the silver market is likely driven by its long-term economic and geopolitical goals. By securing key resources, China aims to reduce its dependence on foreign suppliers, enhance its economic resilience, and gain leverage in international relations. This strategy is particularly relevant as China seeks to expand its influence through initiatives like the Belt and Road Initiative and the internationalization of the renminbi. In conclusion, historical precedents of commodity control by major economies provide valuable insights into China's current maneuvers in the silver market. By increasing its silver reserves and securing supply chains, China is positioning itself to exert significant influence over a critical resource, with potential implications for global markets and geopolitical dynamics. As we continue to explore China's strategy, it becomes clear that the silver market could be on the brink of significant changes, driven by historical lessons and future ambitions.
And, in some sense, like my views are evolving as I see more data coming through. I think, obviously the big run-up in gold over the last 2 months, I think, the market wanted to basically put it down to rising geopolitical risk. But I'm not sure that's actually the explanation because, if it's geopolitical risk, then gold and oil should really be moving in the same direction. And then actually, believe it or not, they really haven't, at least on a day-to-day basis, the correlation hasn't been all that strong, which actually, forces everybody to sort of look for other potential explanation. And I think, even though some of them actually is difficult to prove, and I'm starting to think that actually China has played a bigger part than I expected. I think, this is actually the big, I think, new news that came out last week, which was that the World Gold Council, I don't know if you saw that report, came out with actually a very interesting analysis in which they claim that actually China, we're talking about the Chinese central bank, has been adding gold more aggressively than their monthly data have, have suggested. And that's interesting because, we have various ways to get basically get a read on Chinese reserve accumulation, basically in terms of gold. And the IMF actually publishes that, in the context of all the countries at the same time. And according to WCG, WGC, in fact, they claim, and I have to believe that they have some reasons to basically draw that conclusion, which is that China has been adding gold more aggressively and more rapidly over the last 3 or 4 months than actually the monthly IMF numbers would suggest. So I think that was like a bombshell when I saw it, because it was like, well, listen, because until that report came out, I think everybody, including myself, was in the assumption that the pace of Chinese gold reserve accumulation was actually slowing based on the IMF numbers. Right? Therefore, it was impossible to sort of put down the gold rally to actually China. But now, there is evidence to suggest that actually the IMF numbers were wrong, or rather the Chinese were going out of their way and trying to hide the activity, which is also understandable because the Chinese don't want everybody else to front run them, right? I mean, if you think about this, right? I mean, if you're going to buy a lot of gold and everybody knows that China is a massive player, if they're just talking about diversifying 1%, 2% of their reserves into gold, I mean, that's going to send gold sharply higher. So they have an incentive to sort of play down what they're up to. And we've seen that actually in the past, US Treasury basically buying by China in 2017, for example. We saw that China was trying to basically hide what they were doing by parking their Treasury holdings with Belgium, as opposed to typically with New York Fed. But be that as it may, that's the problem when you're a very big guy trying to basically do certain things in the market and everybody's just going to basically front run you. So I think, but be that as it may, I think the story here is that apparently China has continued to buy, gold at a record pace. And moreover, they're trying to hide, which would suggest that they probably have a lot more to do. So from that point of view, I think, the World Gold Council report that came out last week was, both important and pretty bullish for gold.
Analyzing current market indicators provides us with a clearer picture of the dynamics at play in the silver market and the impact of China's strategic maneuvers. Several key indicators suggest that the silver market is poised for significant changes, potentially driven by China's aggressive accumulation and market positioning. Firstly, the price of silver has been on a roller coaster ride in recent months. After experiencing a dip earlier in the year, silver prices have shown a steady upward trend, reflecting increased demand and market speculation. Analysts have noted that this price movement correlates with reports of China's heightened silver purchases. The increase in silver reserves by China indicates a strategic stockpiling effort, which is creating upward pressure on prices. Secondly, industrial demand for silver remains robust, driven by its essential role in manufacturing and technology sectors. The global push towards renewable energy has significantly boosted demand for silver, especially in the production of solar panels. As countries strive to meet their green energy targets, the demand for silver is expected to continue rising. China, being a leader in green technology and the largest producer of solar panels, is at the forefront of this demand surge. The increased industrial use of silver is a critical factor that supports higher prices and market stability. Additionally, market speculation plays a significant role in the current silver market dynamics. Investors, both retail and institutional, are closely monitoring China's actions. The anticipation of potential supply constraints and further price increases has led to increased speculative activity. This is evident in the trading volumes on major commodity exchanges, where silver futures have seen a notable uptick. The silver squeeze movement earlier this year, where retail investors attempted to drive up silver prices through coordinated buying, underscores the impact of speculative forces on the market. The broader economic context also provides important insights. The global economy is projected to grow steadily over the next few years, as per the OECD's latest economic outlook. However, this growth is accompanied by significant uncertainties, including potential inflationary pressures and geopolitical tensions. Inflation concerns, in particular, drive investors towards precious metals like silver, which are considered safe haven assets. The projected easing of headline inflation from 6.9% in 2023 to 3.4% by 2025, supported by tight monetary policy, suggests a stabilized economic environment. Yet, persistent inflation risks could continue to support strong demand for silver as an inflation hedge. Geopolitical factors also heavily influence market sentiment. The ongoing tensions between China and the United States, coupled with the broader de-dollarization trend, have significant implications for the silver market. As China seeks to reduce its reliance on the US dollar and bolster the renminbi's international role, accumulating precious metals like silver is a strategic move. This geopolitical strategy is not just about economic security, but also about asserting influence in the global financial system. Moreover, China's financial policies and market interventions are crucial indicators to watch. The Chinese government has been actively managing its currency and foreign exchange reserves, including significant purchases of precious metals. This interventionist approach is aimed at stabilizing the domestic economy and preparing for potential external economic shocks. The People's Bank of China's efforts to accumulate gold and silver reserves are part of a broader strategy to diversify away from dollar-denominated assets.
I think obviously the world is divided between those who are pro-US versus those who are pro-China. I'm neither pro-US nor pro-China. I'm just looking at this basically chess game and trying to basically figure out who's got the upper hand, who's going to win. And by the way, there will be many, many rounds of this game to be played out over the next decade, 2 decades, and so on and so forth. So, there is no way you could, I don't think one side has such an upper hand that, that this is just going to be a one-sided basically game. But I think for the time being, at least, I think, what a lot of people don't realize is that, as you said, if you look at aggregate debts, right? We're talking about government debt, corporate debt, and household debt. These are the 3 main sources of debt. If you add them all up and divide basically it by GDP, you get the total actually real debt burden, if you like, okay? What the degree of indebtedness of the entire economy, okay? And on that basically score, China has already reached US level, okay? And US is quite indebted, but no more indebted relative to GDP per capita in the US, because generally speaking, you find that richer countries are able to take on more debt than poorer countries for obvious reasons, because richer countries, that means that they have more leftover income with which they can pay interest on their debts if they so basically choose to. So in general, rich countries sit on more debt. China, of course, is still a relatively poor country compared with the US, at least, on a either on a PPP, per capita adjusted basis, or basically in nominal terms and so on and so forth. And for a basically upper middle income country, which is what China is currently, I mean, Chinese debt is very, very high. Okay. So from that point of view, I would argue that actually China, relative to this income level, is sitting on more debt than the US. So from that point of view, it doesn't make any sense that China somehow is going to basically offer itself as, the alternative to the US dollar as a reserve currency. Because at the end of the day, if people are running away from the US dollar, it's because they're worried about, the debt buildup and then the incentive that future governments are going to have to resort to inflation or default and whatnot to basically deal with the debt problem. But if that is what you're concerned about the US dollar, you should be equally concerned about that as far as China is concerned. And certainly, I can tell you that much is very, very clear. Like right now, if it weren't for continued intervention, currency intervention, basically by the Chinese government, most likely via, state-owned banks, the RMB will be much weaker right now than it currently is.
The global economic outlook plays a pivotal role in shaping the dynamics of the silver market, particularly in light of China's strategic maneuvers. Several key aspects of the global economy influence silver prices, demand, and overall market sentiment. Understanding these factors helps us grasp the potential impact on the silver market as China continues its aggressive accumulation strategy. According to the OECD's latest economic outlook, the global economy is expected to grow at a steady pace, with a projected GDP growth of 3.1% in 2024, matching the growth rate of 2023, followed by a slight increase to 3.2% in 2025. This steady growth suggests a relatively stable economic environment, which is generally positive for industrial demand, including for silver. As industries expand and infrastructure projects increase, the demand for silver, particularly in sectors like electronics, solar energy, and medical equipment, is likely to remain strong. However, this growth is accompanied by several challenges. Tight monetary conditions, especially in major economies, continue to exert pressure on housing and credit markets. While global activity remains resilient, the lingering effects of high interest rates could dampen investment and consumer spending. This dual effect of growth and tight monetary policy creates a complex backdrop for the silver market. On one hand, industrial demand supports prices, while on the other, higher borrowing costs could limit speculative investment in commodities like silver. Headline inflation in the OECD is projected to ease from 6.9% in 2023 to 5% in 2024, and further down to 3.4% in 2025. This decline is attributed to tight monetary policies and decreasing goods and energy price pressures. As inflation moderates, the purchasing power of consumers improves, potentially increasing demand for industrial goods that require silver. However, persistent inflation risks could drive investors towards silver as a hedge, maintaining upward pressure on prices. The regional economic outlook varies significantly, impacting silver demand and market stability. For instance, the United States is expected to see GDP growth of 2.6% in 2024, slowing to 1.8% in 2025 due to high borrowing costs and moderating domestic demand. In contrast, the euro area, which experienced stagnation in late 2023, is projected to recover gradually, with GDP growth of 0.7% in 2024 and 1.5% in 2025. Japan is also expected to see steady growth, driven by stronger real wage growth and accommodative monetary policies. These regional differences highlight varying levels of industrial demand for silver, influencing global supply and price trends. China's economic outlook is particularly pertinent. The OECD projects China's GDP growth to slow moderately to 4.9% in 2024 and 4.5% in 2025, supported by fiscal stimulus and exports. As China continues its industrial expansion and green energy initiatives, the demand for silver is expected to remain robust. The country's fiscal policies, aimed at stimulating economic growth, also support higher silver consumption. Furthermore, China's strategic stockpiling of silver aligns with its long-term economic goals, providing a buffer against potential economic slowdowns and geopolitical risks. Geopolitical tensions and their economic repercussions are another significant consideration. High geopolitical tensions, particularly involving major economies like the US and China, pose near-term risks to economic activity and inflation. For instance, the evolving conflict in the Middle East and increased tensions in the Red Sea could disrupt trade routes and supply chains, impacting global commodities, including silver. China's strategic maneuvers in the silver market can be seen as a hedge against these geopolitical uncertainties, ensuring a stable supply of a critical resource. The de-dollarization trend also plays a role in shaping the economic outlook. Policymakers in emerging markets are increasingly advocating for alternatives to the US dollar in trade and finance. This trend is driven by geopolitical and macroeconomic concerns, with countries like China and Russia leading the charge. As China increases its silver reserves, it is also part of a broader strategy to reduce reliance on the dollar and strengthen the renminbi's international role. This financial strategy adds another layer of complexity to the global economic outlook, potentially influencing silver market dynamics.
Now, right now, the biggest problem that gold has, of course, is the fact that it doesn't pay any interest. Right now, you park your money in US dollar, you get 5.5%. In gold, you're getting zero. So that is a problem. But hopefully that problem is not going to become a permanent problem because, obviously, the economy is going to slow. Either if you get a situation where like economy starts to slow for whatever reason, there's no way U.S. economy can sustain, this level of growth and interest rates for a very long time. In fact, I think, most likely 2025, we will probably see a pretty big slowdown because for one thing, if for nothing else, a lot of U.S. company borrowers, we're talking about corporate, debt issuers, they're going to have to roll over the cheap debt that they issued back in 2020, 2021, when they were able to borrow money for practically nothing. So I think, in that respect, we should start to see, credit spreads widening, credit costs starting to increase, okay, and therefore reducing, investment and hiring and economy slowing. And especially given the next administration, I think, it's unlikely that we're going to see anything like what we've seen over the last 3 years in terms of fiscal stimulus. Because even if Trump were to win, I'm not sure to what extent he's going to be able to have filibuster basically proof majority in the Senate. And I'm not even sure Trump even wants to basically go down the path of cutting taxes and so on and so forth, especially with the budget deficit of $2 trillion. So I think all in all, when the economy slows, interest rates come down, that's when gold is going to get, a bit of a boost.
Geopolitical factors are playing an increasingly significant role in the dynamics of the silver market, especially in the context of China's strategic maneuvers. The interplay between global political tensions and economic strategies can profoundly impact market conditions, influencing supply, demand, and prices of critical commodities like silver. Understanding these geopolitical factors is crucial for grasping the potential implications of China's actions in the silver market. Firstly, the escalating tensions between the United States and China are a central factor. The ongoing trade war, technological rivalry, and military posturing in regions such as the South China Sea contribute to a fraught relationship between the two largest economies in the world. These tensions have led to a series of economic sanctions, tariffs, and restrictions that complicate international trade and investment. For China, accumulating silver and other precious metals is a strategic move to mitigate the risks associated with these geopolitical frictions. By increasing its reserves, China aims to reduce its dependency on the US dollar and safeguard its economic stability against potential sanctions or economic disruptions. In addition to the US-China rivalry, the broader trend of de-dollarization is reshaping global financial systems. Emerging markets led by China and Russia are seeking alternatives to the US dollar for trade and finance. This movement is partly driven by the desire to escape the geopolitical influence exerted through the dollar-dominated financial system. China's accumulation of silver can be seen as part of its strategy to promote the renminbi as a global currency. By holding substantial reserves of precious metals, China can enhance the credibility and stability of its currency in international markets. The geopolitical landscape in other regions also impacts the silver market. For example, the conflict in Ukraine and the resulting sanctions on Russia have significant implications. These sanctions have disrupted global supply chains, particularly for commodities, leading to price volatility. Russia's exclusion from the SWIFT international banking system has further heightened the urgency for countries to find alternatives to dollar-based transactions. China's strategic positioning in the silver market can be viewed as a hedge against these geopolitical disruptions, ensuring it has access to critical resources irrespective of global tensions. Moreover, China's Belt and Road Initiative, BRI, is a key geopolitical strategy that influences its economic maneuvers. The BRI aims to create a vast network of trade routes and infrastructure projects across Asia, Europe, and Africa, enhancing China's economic and strategic influence. Many of the countries involved in the BRI are rich in natural resources, including silver. By securing long-term agreements and investments in these regions, China not only ensures a stable supply of silver, but also strengthens its geopolitical alliances. This strategy helps China mitigate the risks of geopolitical conflicts and trade disruptions. The geopolitical dynamics in the Middle East also play a crucial role. The region's instability, marked by conflicts in countries like Syria, Yemen, and ongoing tensions between Israel and Iran, impacts global energy and commodity markets. Any significant escalation in these conflicts can lead to disruptions in trade routes and affect the supply of commodities, including silver. China's strategic accumulation of silver is partly a response to these uncertainties. By increasing its reserves, China can buffer against potential supply disruptions caused by geopolitical conflicts in this volatile region. Furthermore, China's relationships with other major economies, such as the European Union, Japan, and India, also influence the silver market. The EU has shown signs of wanting to reduce its dependency on the US dollar, aligning with China's de-dollarization efforts. Japan and India, while having complex relationships with China, also engage in significant trade involving precious metals. Any shifts in these relationships can impact the global supply and demand for silver. China's internal geopolitical strategies also matter. The Chinese government's efforts to maintain internal stability and control, especially in regions like Xinjiang and Hong Kong, can influence its economic policies and international strategies. The need to secure critical resources like silver is partly driven by the desire to ensure internal stability and support economic growth amidst potential internal and external pressures.
Okay. So it doesn't make any sense. And then also these countries don't really have an incentive to really like create one single currency because like, well, okay, it's fine. So, like how's it going to work actually? Because if you think about this, right? I mean, there's a whole literature in economics called the common currency area, right? I mean, so if you think about this, like the Eurozone, to create a euro, you had to basically get all these countries, there were many of them, even at the very start of the whole Eurozone project, to actually agree on certain basically economic objectives, debt to GDP ratio, trying to bring inflation to a certain level, and so on and so forth. In other words, that they were trying to encourage these countries to converge to the same economic paradigm before these countries then go ahead and adopt a single currency. Like, the BRICS countries are so different right now. It just like, it makes no sense for me for them to share a common currency. Sure, if you're talking about just transacting like in the RMB or, Russia trade with China and RMB, or India trades with Russia and rupee, that's not a big deal. That really isn't a big deal. But to go ahead and say, you know what, we're now going to launch a single currency to challenge the dollar, we're going to back it with gold and so on and so forth. For one thing, there's not enough gold in the world. Secondly, those countries are so different in terms of their fundamentals that it wouldn't be either feasible or even desirable for them to basically create a single currency. And because at any given point in time, that currency may be too strong for one country and too weak for another country. Just think about this. I mean, it's a total mess, actually, and this is why, the euro, after 20 years of its introduction, the euro is still struggling because of the, diversity and the heterogeneity among the countries who are part of the Euro club. And I think from that point of view, it just doesn't make any sense for the BRICS countries. So, I mean, people talk about it, but, it's just sort of like most people have never really thought through this proposal. I mean, I started my career at the International Monetary Fund. This is what I, do. This is what I did for a living for many years. And a lot of people have been thinking about these things for a very long time. And to me, it's not obvious why it makes sense at all for these countries to embark on this path.
To gain a deeper understanding of the potential impact of China's maneuvers in the silver market, it is essential to consider insights from market experts and analysts. These experts provide valuable perspectives on how China's strategic accumulation of silver might influence market dynamics, prices, and global economic trends. Renowned financial analyst David Wu has been particularly vocal about China's activities in the silver market. According to Wu, China's aggressive silver purchasing is a calculated move to diversify its reserves and reduce its dependency on the US dollar. Wu highlights that China's strategy is not just about securing a critical resource, but also about positioning itself as a dominant player in global commodities markets. He suggests that by controlling a significant portion of the silver supply, China can exert influence over global prices and market stability, giving it an edge in international trade and economic negotiations. Another expert, Jeffrey Christian, managing partner of CPM Group, emphasizes the industrial importance of silver in China's economy. Christian points out that China's green energy initiatives, particularly in solar power, are driving substantial demand for silver. He notes that China's commitment to expanding its renewable energy infrastructure necessitates a steady and reliable supply of silver. This industrial demand, combined with strategic stockpiling, positions China to benefit from any future price increases driven by global economic trends or supply constraints. Analysts from major financial institutions like Goldman Sachs and JP Morgan also provide critical insights into China's market activities. Goldman Sachs analysts have observed that China's silver purchases are part of a broader trend of increasing its precious metals reserves. They argue that this trend is indicative of China's preparation for potential economic volatility and geopolitical uncertainties. JP Morgan analysts add that China's actions could lead to supply shortages, driving up silver prices globally. They suggest that investors should monitor China's buying patterns closely, as continued accumulation could signal further price increases. Market commentators on financial news platforms such as Bloomberg and CNBC have also weighed in on China's strategy. Bloomberg's commodities analyst, Lydia Zhou, explains that China's approach to the silver market reflects a strategic long-term vision. Zhou argues that by securing large quantities of silver, China is not only safeguarding its industrial needs, but also positioning itself to capitalize on future market opportunities. She highlights that China's ability to influence global prices could have significant implications for other major economies, particularly those reliant on silver for industrial and technological applications. Experts from the World Gold Council, WGC, have also commented on China's strategic accumulation of silver. The WGC's recent reports indicate that China has been adding to its gold and silver reserves more aggressively than previously reported. This revelation suggests that China is deliberately downplaying its market activities to avoid triggering premature price spikes. The WGC analysts emphasize that such behavior is typical of large market players looking to accumulate substantial positions without attracting too much attention. This stealth accumulation strategy allows China to buy silver at favorable prices before potential supply constraints push prices higher. Independent financial advisors and precious metals consultants provide additional perspectives on the potential impact of China's maneuvers. Adrian Day, a prominent precious metals investor, suggests that China's actions could lead to a revaluation of silver's role in global finance. Day argues that if China continues its aggressive accumulation, it could spark a broader interest in silver as a strategic asset, leading to increased investment from other countries and institutional investors. This shift could result in sustained higher prices and increased market volatility. Technical analysts also offer valuable insights into the implications of China's market activities. Chart patterns and technical indicators suggest that silver is entering a bullish phase, driven by strong demand and strategic buying. Analysts from TradingView, for example, have identified key support and resistance levels that indicate potential breakout points for silver prices. They suggest that China's continued accumulation could push prices past these resistance levels, triggering further buying from momentum traders and institutional investors.
I would argue that the trust between the US and China right now is all-time low. And I think the Chinese are very, very wary of the US doing to China what it did to Russia, which is to basically like freeze out, Russian asset, right? I mean, I don't have to tell you, right? So I think from that point of view, we've had two, pretty serious visits by U.S. officials, just of the last month. You had Janet Yellen there, and then followed by another visit by Anthony Blinken last week. And Anthony Blinken's basically saying to the Chinese, the message was very, very wow. Anthony Blinken's basically said that you guys need to stop supporting Russia in this war, or otherwise you're going to be facing serious punishments. So I think from that point of view, I think the U.S. decided to play hardball with the Chinese. I think China, on the other hand, there's no way, and then rightly so, China should not allow Russia to basically lose this war, because China also knows that if Russia were to basically lose this war, then China will be next. I mean, there's no doubt. I think at this point, the U.S. has crossed the Rubicon. Under the Biden administration, this is a sharp departure from what happened under the Trump administration. I've always said, under Trump, the U.S. did not enter. It was the first time since Jimmy Carter, the U.S. did not commit new troops to a new foreign conflict. But whereas since Biden basically took office, the U.S. is fighting one war after another, the world is edging ever closer to World War III. So I think from that point of view, I think, the Chinese are just at this point, they're just completely, there's no trust at all. And, I think especially against the potential, major offensive that I think the Russians are about to launch in Ukraine to basically finish the war once for all, I think the Chinese naturally will be rather hesitant, that the U.S. will basically come down with them, with a ton of bricks. So I think from that point of view, better basically be early than sorry. And I think one of the ways that they've been trying to get out, in terms of reducing the exposure to U.S. assets, you see that every month they're selling more and more U.S. treasuries. And then naturally, they've been probably putting some of that money to work by diversifying into gold.
To summarize, China's strategic maneuvers in the silver market are poised to create significant shifts that could drive prices to unprecedented heights. By examining the evidence and expert insights, it becomes clear that China's actions are meticulously calculated to achieve several key objectives, each of which contributes to the potential for silver prices to reach $2,000 in the coming weeks. Firstly, China's aggressive accumulation of silver reserves is a clear indication of its intent to control a substantial portion of the global supply. This accumulation serves multiple purposes. It secures the necessary resources for China's burgeoning green technology sector, particularly solar panel production, and provides a buffer against economic and geopolitical uncertainties. As China continues to stockpile silver, the resulting supply constraints will inevitably push prices higher. Secondly, the global economic outlook supports this upward trajectory. Steady GDP growth, coupled with moderating inflation, creates a favorable environment for industrial demand. However, the persistent risks of inflation and geopolitical tensions drive investors towards safe haven assets like silver. This dual demand, from both industrial sectors and investors seeking stability, adds further upward pressure on prices. Moreover, China's strategy to diversify away from the US dollar and bolster the renminbi's international role adds another layer of complexity. By increasing its silver and gold reserves, China strengthens its financial position and reduces its reliance on the dollar-dominated financial system. This move is part of a broader de-dollarization trend that could reshape global financial markets and increase the strategic value of precious metals. Geopolitical tensions, particularly between the US and China, further exacerbate the situation. As these two superpowers continue their economic and military posturing, the risk of economic sanctions and trade disruptions looms large. China's accumulation of silver is a strategic hedge against these risks, ensuring it has the necessary resources to maintain economic stability regardless of external pressures. The historical context of commodity control by major economies highlights the potential impact of China's actions. Just as the U.S. leveraged its control over oil in the 20th century to exert global influence, China is now positioning itself to use its control over silver to gain strategic advantages. This historical precedent underscores the potential for China's maneuvers to create significant economic shifts and drive up silver prices. Expert insights confirm that China's actions are likely to lead to supply shortages and higher prices. Analysts and market commentators agree that China's aggressive buying will tighten the market, making it difficult for other buyers to secure silver at current prices. This scarcity will naturally drive prices up, potentially reaching the $2,000 mark as predicted. In conclusion, all these factors converge to create a perfect storm for the silver market. China's strategic accumulation, combined with favorable economic conditions, geopolitical tensions, and historical precedents, sets the stage for a dramatic price increase. As silver prices continue to rise, driven by these multifaceted dynamics, reaching $2,000 in the coming weeks is not just possible, but increasingly likely. Investors and market participants should prepare for this significant shift and consider the implications of China's bold strategy in the silver market. Don't forget to subscribe to our channel to stay updated with the latest insights and market analysis. And remember, while this information is based on extensive research and expert opinions, it is not financial or investment advice. Always consult with a professional before making any investment decisions.
And the short term can last a very long time, because, in some sense, long term is just a series of short term. I would say short term, ironically, the U.S., basically this very, very hawkish, Biden administration that wants to declare war on the whole world practically, okay? It's actually bullish for the US dollar in the near term. I'm just thinking about this, right? By pushing Europe into basically this, let's go out and destroy Russia bandwagon. I don't want to tell you, Europe is now paying much higher energy prices, okay, than before the Ukraine war. And there's no doubt, like Europe, the cost to Europe is deindustrialization of Germany, which is still ongoing, okay? So I would argue, if you think about this, like the US war on Russia and China, for one thing, has weakened Europe seriously. I would argue it's weakened Europe more than it's weakened actually Russia, because just look at the Russian economy is doing very well, and the European economy has literally been on its knees. So US has been hurting its allies, and as a result, the euro has been weak, and sterling has been very weak against the US dollar. Now, if you look at actually in Asia, right, Japan and South Korea, the two major US allies, their biggest export market is China. And then because the US is basically forcing them to adopt, basically much tougher, basically policy vis-a-vis China through sanctions and so on and so forth, as a result, these countries have done not very well either. And as a result, those currencies have been very weak against the US dollar. So all in all, obviously the fact that the Chinese right now, they're facing potential more tariff from the US, more protectionist measures and so on and so forth. The Chinese economy, which as everybody knows, is quite dependent on export, is now struggling for that reason. So this is why the RMB is weak. So ironically, the US is kind of like, the US policy under Biden, as much as, temporarily is shoring up US hegemony, actually, ironically, has actually helped brought about a stronger than expected dollar, at least in the near term. So from that point of view, this is actually interesting, because in some sense, this, you could argue that's the reason why US, has managed to outperform the rest of the world in terms of the growth, of the last 24 months. Of course, on top of that, you also have had very, very expansionary fiscal policy under basically Biden. That's how basically supported US growth. But I think in general, in the very short term, so far, the US, basically foreign policy under Biden, I would argue has actually helped the dollar by weakening both US adversaries as well as US allies.